Netflix reported earnings late yesterday, and there should have been so much to cheer about. The company beat Wall Street estimates everywhere. Earnings per share, revenue, gross margin, subscribers. But the whole world is zeroing in on one alarming development. Costs, they ballooned, and the stock is getting hammered this morning. Piper Jaffray analyst Michael Olson is a Bloomberg best on Netflix. He kept his overweight rating on the shares, and he's with us from Minneapolis. So, Michael, I take it you aren't as concerned about those ballooning costs as the investors who've sold the stock down to $237 this morning.
No, we're not. I mean, the bottom line is not everyone's going to be happy today, but they're laying a foundation for growth in a couple areas, international expansion and the growth of streaming content.
Okay, but there should be some leverage here, should there not? Netflix revenue is growing at a torrid pace, over $700 million in the most recent quarter. Shouldn't earnings be growing by at least as much, if not more?
Well, earnings growth is still significant, but the bottom line is to create a competitive differentiation. They're going to spend about $1.5 billion on streaming content next year, and we think that creates a pretty big mountain for any competitor that tries to enter the space.
Okay, that's fair enough. Absolutely, there are lots of would-be competitors: Hulu, Amazon, Coinstar, etc. But the share price, as of yesterday, right, in excess of $250, implies a certain rate of profit growth in the not-too-distant future. If Netflix has to spend this much money to secure the lead that it has, is it not possible that some of those profits won't materialize the way that investors want them to, and as a result, it's not worth as much?
Yeah, I mean, I think we still estimate that Netflix is going to grow earnings 45% or more for the next 2 years, and they grew earnings on a GAAP EPS basis by over 80% this quarter. So the earnings growth is still pretty significant for a company of this size. How
about, again, let's focus on the costs for a moment. There's the gross margin line and the operating expenses. Operating expenses ballooned, mushroomed in the most recent quarter, but the guidance had more to do with the gross margin. They're talking about 30 to 35%, down from 39% this quarter. Do you think they're talking the street down too much, or is that something that we need to build in, let's say, for the next several quarters, 30 to 35%?
Yeah, I mean, I think the reality of it is they are probably being somewhat conservative with that metric. We're assuming a gross margin in the range of kind of 34 and 33% over the next couple of years. So we think it'll be at the very least at the high end of that range.
How about the competition that Netflix is going to face increasingly from the entrenched cable and satellite providers? As my colleague John Ehrlichman just pointed out, Netflix now has more subscribers than Comcast. How much longer can they sell themselves as a supplementary service? Surely the folks at Comcast and Dish and other companies are beginning to wake up to the fact that Netflix is a replacement service, not a supplementary service, and as a result, there's going to be that much more competition for content, and the costs are going to go through the roof.
Yeah, I mean, as long as Netflix is providing what we would call library content, which is typically older movie titles and TV shows that are from prior seasons, I think the bottom line is that it is somewhat supplemental. And I think that there's going to be increasing competition from Comcast and the like with Xfinity and TV Everywhere like services.
Okay, let's talk then about your expectations for the stock. Let's say it opens today at $237, which is where it's trading in Europe right now. How much higher do you think this stock can run in the next 12 months?
Well, we still think that, like I said, given an earnings growth rate of 45% or more over the next couple of years, that the stock should be able to achieve an earnings multiple in a similar range, around a mid-40s multiple. And based on that, we think the stock could move into the high 200s over the next couple of months, which would be, or next 12 months, I should say, which would be about a 20% move from these levels.
All right, Michael, thanks for joining us this morning. Michael Olson, he's a Bloomberg best on Netflix. He's with Piper Jaffray.